Hi, I'm Kep Kepner CPA here in Dallas. So we're talking about one of my clients. We'll call him alias Roger because he came to me and we finished his tax return, but he filed it late. So he owed over $900,000 and 15 of it was penalties for late filing and late paying his tax. So we had a conversation. And as I've said in other videos, this is the same conversation I have with people who maybe owe $5,000. So he was really upset that he had to pay $300,000 in tax. Just doesn't seem fair. I reminded him that the people in the top 1% of the taxpayers, which includes him at $900,000 a year, he's paying 38% of all the taxes, his group, 38% of all the taxes in the U.S. So it's a pretty big burden. And when you hear people talking about, well, the rich don't pay their share, well, this is the top 1%. They're paying 38% of all the taxes. So, but he asked the question, well, what can I do about it? So there are several strategies. The first one is that if he has the ability to reinvest in his business and make it grow, then he has an opportunity to sell his business and realize the wealth that comes from owning an income machine like his business is. You may know in the stock market there's a term called price earnings ratio, and that is calculated by taking the price of the stock and dividing it by the income per share or the net profit per share and calculating a number. It might be like 17, so that means the price of the stock is 17 times the per share earnings. So if you have a small business, two things happen. When you continue to make money, it grows in value, and as your business grows, you're making more profit. So your business becomes more valuable. On the other hand, the second thing that happens is your price earnings ratio increases as your business grows. So if you have a little business doing $1 million and making you $200,000 a year, maybe you can get 3 times earnings for that business. There's a lot of risk to a buyer. Wonder if they can still make 200,000. Maybe it's depending too much on you and not on your business as a standalone entity. As you grow, and let's say you make that business be a $10 million business and you're making $2 million a year, at that point a buyer can look at it and have more confidence because you're probably not doing all the work. You probably have systems in place. You have revenue channels. You have methods to create your product and deliver it to your customer. So a buyer will pay a higher price or a higher price earnings ratio for a bigger company than they will for a smaller company because the risk is less. So in my alias Roger client, one of his strategies is to pay the tax, because he's got to do that, and reinvest some of that money in growing his business. Then next year, maybe he's going to make not 900,000, but maybe he's going to make $1,000,004, and he's going to be upset that he's got to pay 40% of that in tax, and he's going to be upset about it. But he will have grown the value of his business, and eventually that business can grow to the size that he can sell it, and he can sell it for a capital gain. So the money he gets on the sale of business ends up being taxed at 20%, not 40% like regular income. So people who earn money need to understand what their options are. One is to reinvest in your own company, make it grow in value so you can sell it. And we can help you with that. Give us a call. Thanks.